wabarakatuh. Dimatiin aja.
Assalamu alaikum, Dr. Sultan.
Waalaikumsalam, Dr. Rizwan. How are you?
Alhamdulillah, how are you?
Alhamdulillah, good. Thank you.
Excellent. MashaAllah, you're driving.
No, not driving.
You're
In
on
the
your
car.
way to Dubai.
Yeah.
All right, okay, inshallah. So I think we will start in about 5 minutes, inshallah.
Okay, no problem.
Assalamu alaikum.
Walaikum assalam.
Waalaikumsalam warahmatullahi wabarakatuh.
Brother Umar, shall we start?
I think we should start.
بسم الله الرحمن الرحيم الحمد لله رب العالمين والصلاة والسلام على أشرف الأنبياء والمرسلين نبينا محمد وعلى آله وصحبه أجمعين. Excellencies, distinguished guests, my brothers and sisters, Assalamu alaikum wa rahmatullahi wa barakatuhu, and a very good morning, good afternoon, and good day to all of you joining us from different parts of the world. On behalf of Accounting and Auditing Organization for Islamic Financial Institutions and its partners for this particular public hearing, in particular KNEKS from Indonesia, INCF and ISRA, Salihin Advisory, and other advisory from Malaysia, we welcome you to this important public hearing session on an important standard issue, on an important exposure draft issued by AOFI Accounting Board. This exposure draft, as it's named, transfer of assets between investment pools, is part of a revision exercise that AOFI Accounting Board initiated in 2018. As part of this revision exercise, it was ascertained that there is a need to revise various financial accounting standards issued by AOFI over the years. As a result, this standard will be superseding the earlier standard, FAS 21, disclosure of transfer of assets. Certainly there are other standards that are in the pipeline that are being revised. This is the second public hearing on this particular standard. So we would request all of you to kindly share your feedback, comments, either through Q&A tab, which is at the bottom of the screen, or by raising your hand. And if time permits, we would allow you to ask your question by voice as well. So this standard is a short standard. This will be, and as such, the public hearing is scheduled for about 2 hours. However, we would like to ensure that more and more comments are received and feedback is received on this standard. So if you have not read the standard already, or the exposure draft, then shortly it will be placed in the chat window. Please click on it to read through it. And if you wish to share your comments and feedback later on, please do that by writing to accounting@aofi.com. So without any further ado, let me have the pleasure of inviting my brother, Dr. Sultan Amir Hidayat, the director at KNEKS for infrastructure-related initiatives, to deliver his welcome remark. We are very thankful for the support that comes from KNEKS in terms of conducting these public hearing sessions, and in particular this session, as it is focused on the Far East region in particular. Of course, it's open to all the stakeholders globally as well. So let me hand it over, and I welcome Dr. Sultan to deliver his welcome note before we proceed to the standard itself.
Thank you very much, Dr. Rizwan Malik. Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. Alhamdulillah, salatu wassalamu ala rasulillah, amma ba'du. Rabbi syrah li sadri wa yassir li amri wahlul 'uqdatan min lisani yafqahu qawli. Distinguished guests and speakers, Brother Mr. Umar Mustafa Ansari, Secretary General of AOFI, representative from INCIF, ISRA Research Management Center, then Adil Advisory, and then Salihin Syariah Advisory, and all participants, ladies and gentlemen. Firstly, let us praise and thank Allah Subhanahu wa Ta'ala for His grace and mercy, so we may gather here virtually in this very important event. It is my great pleasure to give a remark in this public hearing on the exposure draft of AOFI standard on accounting, namely transfer of assets between investment pools. Let us convey our salawat and salam to our beloved Prophet Muhammad sallallahu alaihi wasallam, the greatest role model for all humankind, who laid the foundation for the development of human civilization. Ladies and gentlemen, the transfer of assets between investment pools is a common practice in the realm of Islamic finance, particularly in the context of investment funds and collective investment schemes. These transfers are conducted to optimize portfolio composition, manage risk, and meet the changing needs of investors. To ensure transparency, accountability, and compliance with Islamic principles, the AYP has developed comprehensive standards that govern the accounting treatment of such transfers. As we know that Islamic finance operates under the principles of Sharia, which prohibits riba, gharar, and any other unethical activities. The implementation of this OIP standard, or the draft that we are discussing today, will provide guidance on ensuring the transfer of assets between investment pools adheres to these principles, safeguarding the integrity and ethical aspects of the transaction. In addition, AYP standards establish uniform accounting and disclosure requirements for asset transfers. This promotes transparency and enables stakeholders to evaluate the financial position and performance of investment pools accurately. Consistency in accounting practices enhance comparability across different investment pools, facilitating informed decision making. Furthermore, the draft that we are discussing today is expected to ensure that investors are adequately informed about the transfer of assets and its potential impact on their investment. Ladies and gentlemen, the transfer of assets between investment pools involve intricate accounting consideration. AYP standards, or the draft that we are going to today, is expected also to address these complexities by providing specific guidelines on the recognition, measurement, and disclosure of transferred assets, including issues related to fair value determination and accounting for any gains or losses arising from the transfer. This standard, inshallah, expected to help the draft that we are discussing today to ensure that auditing processes are conducted in line with Sharia requirements and that auditors possess the necessary expertise to assess the fairness and accuracy of financial statements related to such transfers. Ladies and gentlemen, KNDKS appreciate the initiative undertaken by AYP and also appreciate also to include us as one of the strategic partners for conducting this public hearing. We expect that this public hearing will strengthen the stakeholders' trust towards the standard later on, and of course, in the future, will enhance the trust of the stakeholders towards the Islamic financial industry in general. In closing my speech, I would like to thank AYP and other strategic partners in SIF, ISRA Research Management Center, Adil Advisory, and Salihin Sharia Advisory for collaborating with us, with KNDKS, on conducting this public hearing. Finally, I do hope all participants will gain useful knowledge and insight during this public hearing. I encourage you to be active in this discussion, and thank you very much for your kind attention. Wabillahi taufiq wal hidayah. Wassalamualaikum warahmatullahi wabarakatuh.
Jazakumullah khair. Thank you very much, Dr. Sultan. As usual, it's a pleasure and honor to have you as well as KNDKS partner with us on these important public hearing sessions. And only through these collaborations and discussions collaborations and partnerships, we'll be able to reach to more and more stakeholders, which will result in terms of receiving more and more feedback to ensure that the final standard that once issued is comprehensive and it is relevant to different geographical location, given that when AOFI issues a standard, it is not issued for any one particular jurisdiction, rather it is issued for the global stakeholders to be adopted and implemented in the various markets around the world. So we thank you very much for your support. We also thank INCF, ISRA, RMC, Salihin Advisory, other advisory for their kind support extended in ensuring that the message of these public hearings is reached far and wide to the local stakeholders in particular, where AOFI may or may not have a direct reach. So we thank you very much, and hopefully we look forward to having you in the future public hearing sessions as well. Ladies and gentlemen, without taking any further time, I want to just reiterate that this public hearing public hearing session step is one of the very important step in the standards development process at AOFI. It takes us on average about 2 years to develop a standard. And this particular moment of public hearing, which I'm sure most of you would be familiar with, it is our time for us to take this exposure draft or the document, which is otherwise ready to the public to receive feedback and comments in different shape and form. So from that perspective, it's a very important step for us to to make sure that this is reached to more and more stakeholders globally, and your feedback comments are incorporated within the incorporated in the final standard, or at least it is presented to the relevant working group and the accounting board, and when we talk about the accounting standard. So it's important for you to please share your feedback and comments by writing. Q&A tab is available. Please don't use the chat window. Q&A tab should be used for any questions. And if you wish to ask a question by voice, please raise your hand and we will allow that. This session, for your information, is being aired or streamed live on YouTube as well. So if you wish to refer to it later on, you will be you can do that as well, inshallah. There will be no PowerPoint presentation shared, because the PowerPoint presentation that will be shared is actually the exposure draft standard, which you already have access to. So that's number two. And the third thing is that this public hearing is being, the CPD points are being allocated, this public hearing qualifies for the AOFI CPD points. So if you are an AOFI fellow, please, make sure that you record this and share it with us at the end of the year. So without any further ado, let me have the pleasure of inviting the Secretary General of AOFI, Mr. Umar Mustafa Ansari, to share with you the exposure draft, to take you through both the history as well as the exposure draft that we have at hand. So I welcome Mr. Umar Mustafa Ansari to please take the standard forward.
الرجيم بسم الله الرحمن الرحيم رب اشرح لي صدري ويسر لي أمري واحلل عقدة من لساني يفقهوا قولي. Ladies and gentlemen, Assalamu alaikum wa rahmatullahi wa barakatuh. It's indeed one of the greatest pleasures for me always to be with you guys, having an opportunity to discuss the upcoming standards like this one. And to be honest, at times I feel that some of the standards are very close to my heart. And this is one of those standards. Obviously, whatever we are trying to do in AOFI is everything we believe is important and is supposed to be always important. But what I feel is that as of this this project with regard to investment accounts, and one of the part of the project related to this transfer of assets, there are so many challenges that we have seen in the past. There are so many issues that we have identified. There are so many risks that we identify that actually it becomes a sort of a I won't say something personal. We don't think anything personal here, but to some extent it becomes like a personal challenge, that how to address those issues, how to challenge those situations that are actually prevalent there, and how to bring the changes that are needed to improve the industry. And for sure, again, we know there are practical challenges and restraints and constraints and hurdles and the sort of pressures from all ends, from all the stakeholders' ends, with regard to meeting the expected returns, meeting the targets, keeping things commercially sustainable and profitable. So all these things are important, and within those challenges, how to find out the best solutions. This is one of the important areas from that perspective. This standard, as you see, is a revised standard of our earlier transfer of assets standards, FAS on transfer of assets. Why this standard is being revised? We started, and you are aware that we are already holding public hearings on control, control of balance sheet managed assets, and the quasi equity public hearings are also being planned. Somehow, I think we have been a bit incorrect in planning the public hearings. Means that it should have happened in the right sequence. If there are 4 standards in one project, actually it would have been good that we had kept one round for each one of them, instead of keeping some of the public hearings in frequent weeks rather than keeping the whole cycle. So what I'm just thinking that some of you might not have read the quasi-equity standard on which we did not hold the public hearing till now, which is part of the same project and which is the biggest of the standards within this project. So there are so many things which are interrelated and associated with each other. In a nutshell, this project includes on an overall basis 4 standards, out of which where FAS 27 is being revised in form of off-balance sheet managed assets and quasi-equity standards, 2 standards. Control-related elements, since those are having impact on other standards as well, and those are covered in multiple places by AOFI. So we decided to keep the control standard separate, so that all the upcoming standards will create a reference to the same control standard rather than repeating the. This one was also related to the same set of standards, that is related to investment accounts primarily, but its scope is beyond that. Means that while it is primarily the most common use of this transfer of assets thing that we are talking about applies to the investment accounts and the investment pools underlying the investment accounts, mostly the unrestricted investment accounts or PLS deposits, what we call, it has impacts on takaful industry, it has impacts on off-balance sheet managed assets, and it has impact on all type of Islamic financial institutions. So from that perspective, I personally believe that it would have been better if we had kept the series together. And this is something that I would suggest to my team, that in future they should always be careful about this thing. Coming back to this thing, I'm not sure how many of you have read the quasi-equity exposure draft, standard accounting for quasi-equity that we have issued as exposure draft. But the challenges that are there with regard to the investment pool related profit and loss computation, the biggest of those challenges are related to this transfer of assets part. And for sure, AOFI already has in place a very good standard on this subject, but we decided that while we are improving the overall investment accounts related accounting in line of new AOFI FAS 1, in light of the new framework, applying the new terminology which is being used in the newer standards of AOFI, and in order to align with other standards requirements which are there in the newer standards, the idea was to bring some limited scope improvement to this transfer of assets standard as well. But when we started working on that, we identified that in addition to the limited scope as regard to the terminology update and alignment with the newer phases, there were some areas where we needed some improvement, and that improvement was needed from not only accounting perspective but also from the Sharia and governance perspectives. For example, when the assets are transferred from one pool to another, the tangibility issue, that issue was not that well addressed in the earlier standards. Similarly, with regard to this disclosure part, with regard to this, because earlier it was mainly a disclosure standard, but now we felt that there are some issues with regard to the accounting. And while we do not want to impose the accounting on some of the aspects, because some of the aspects are less the accounting and more business decisions. Like, for example, when a transfer of asset takes place, should it take place at fair value, or can it take place at other than fair value? If you talk to Sharia scholars, the general view that you will find normally will be that it should happen mainly on fair value basis. But yes, we know that on an ongoing basis, always calculating fair values are not possible. So the issue is that what would be the valuation for that, and what would be the accounting policies for these sort of transfers. Earlier standard referred to accounting policy thing, but did not define it very clearly. Now we are defining it more clearly on the accounting policy part. And also, as I mentioned, that with regard to the fair valuation, if it is not used, then if it is used, then how to treat the differences in the fair valuation, and if it is not used, then what is the potential impact that need to be disclosed to the investment account holders. This transfer of asset thing has Sharia issues, it has transparency issues, it has stakeholders' right issues, and obviously it has disclosure and presentation issues. So considering all these things, what we started as a very limited scope revision resulted in sort of significant revision to this standard. So this is the background. Probably we'll be finalizing all the 4 standards at the same time, inshallah. At least they will be, even if they cannot be finalized in one board meeting, still they will be like, sort of covered in, issued in a way that their effective dates, except for the control standard, which is a conceptual standard, so it will become immediately applicable. Other than that, all other standards will become effective on the same date to make it streamlined for the industry. So this is a bit of background, a bit of summary of such significant changes and a bit of rationale for those changes. Let me take you through the standard. As we discussed every time, that this standard presentation is actually the text of the standard. So I'll take you through the important paragraphs. Some of them I'll read out for you as well as a part of public hearing. And then we will take comments on each of the aspects. And obviously, we are available here to respond to any of the questions as well. Any comment that you have, please put it in the Q&A tab. And if you want to talk by using the microphone, as Brother Ridwan already mentioned, subject to time availability, we will allow you for that. But that is subject to time availability. So with that, I would like to share my screen and take you through the standard. I hope my screen is visible to all of you. What is written in the preface and the introduction part, most of it I have already briefed you in a summary form. So I'm not going to read out this section unless anybody has a comment on the preface or introduction section. So if you have any comment on the preface or introduction section, please feel free to mention. Do we have any comments? I can't see any comments and I can't see any hands raised. So let's move ahead. Objective of the standard. The objective of this standard is to establish the financial reporting principles that apply in respect of internal transfer of assets between various investment pools of an Islamic financial institution, the institution. It is not limited to banks only. So we are talking about Islamic financial institutions. So takaful may also be included to the extent relevant. And other Islamic financial institutions also may have to apply this one. The second thing is the earlier standard was talking about the disclosure requirements, mainly presentation and disclosure, but now it is not only a presentation and disclosure requirement, but it addresses, it does not define the treatments, but it addresses the treatments. How? We'll go through it and see. Scope. This standard shall apply to all transfer of assets between investment pools related to and where material between significant categories of owner's equity, quasi-equity, and off-balance sheet under management of an institution. The assets transferred for the purpose of application of this standard include all monetary and non-monetary assets. So we are talking about this standard being being applicable on all transfer. Now, but now let me clarify when we talk about, because in this standard, we have talked about at times where material between significant categories of. So maybe owner's equity may have more than one categories. So similarly, Like for example, there is a equity sukuk, like a sukuk which is tier 1 equity and is disclosed as part of equity. So that might also apply within equity. There are challenges with regard to the quasi equity, that there can be multiple pools within quasi equity, and obviously there have to be off-balance sheet assets under management, which may include restricted investment accounts and al-wakala bil istismar accounts. Now, coming to the definitions, for the purpose of interpreting and applying this standard, the following short definitions are relevant. Investment pool, in the specific context of the standard, comprises of distinct assets whose risks and rewards, wholly or proportionately, are attributable to the funding provided by respective investors within an owner's equity, quasi-equity, and off-balance sheet assets under management of an institution. It is generally a virtual entity and at times a separate reporting entity. There is one comment that we have received more recently in some of the public hearings, that is about the definition of a virtual entity. Our framework has addressed about the concept of a virtual institution and a virtual entity, but and the concept of reporting entity. But this is something on which we have received some comments in the past. So I would like to have your comments now or in writing, as you may provide, that to what extent this term virtual entity is clear to you, and if it needs any clarification or anything. I think we have defined the virtual entity thing in some of the basis of conclusion of our new Windows standard, but there were some additional comments that were more recently received. A lot of people think that the term virtual entity is mixed up with the cyber entity or a online entity, considering the term virtual being used for online activities. This is something on which we try to find some solutions. For us, the virtual entity term is used against a legal entity. So there is a legal entity, and if it is not a legal entity, but it has different stakeholders involved with that, so we use the term virtual entity for that. But we would love to have some more comments on this area. So your comments right now or in writing are welcome. Monetary assets. Why we are defining the monetary assets term here, and we are using it in the specific context of this standard, because the term monetary assets as used in our in IFRS might have different connotation at times. So from the perspective of monetary assets that we want to use here is the tangibility ratio. That anything in form of cash or receivable in form of cash has to be kept equivalent, in terms of transfers. So it cannot be transferred at a value above or below the par value. This is because this is to avoid, the riba in possible riba or possibility of riba in transactions which involve exchange of monetary assets. So according to our understanding and interpretation of Sharia, the monetary assets alone cannot be transferred at a value above or below the par value. However, if the monetary assets are bundled with non-monetary assets in a reasonable tangibility ratio, in that situation, the transfer of asset as a bundle is acceptable. This is something that we have deliberated upon, in this issue, in quite a number of standards earlier. It is addressed in the Sharia side. It is more recently addressed on the Belden standard, the tangibility ratio thing as defined there. But tangibility ratio defined and mentioned and addressed in the Belden standard was not primarily for the purpose of transfers between investment pools. So we have to put for some guidance here, which is applicable mainly on the accounting and presentation and disclosure of the same, rather than Sharia side, because this is not a Sharia standard. This is the accounting, financial report, financial accounting standard. So monetary assets include cash, contractual right to receive cash or another monetary asset from another institution or entity, and contractual right to exchange a monetary asset with another institution or entity. Non-monetary assets in the specific context of the standard for the purpose of computation of the tangibility ratio in line with the Sharia principles and rules may include tangible. Sister Farida? Sister Farida, are you there?
Yes,
Can you make
yes,
a note, please?
Yes, I'm recording.
Yeah, there is a consistency issue in both the definition. I just noted that when here we said computation of tangibility ratio and here we said tangibility ratio in line with Sharia principles and rules. And this was, I think, the comment that was decided to be added at both places. So just make sure that add it to 4B, okay, in line with the Sharia principles and rules. The tangibility ratio in line with Sharia principles and rules. This part has to be added there. Which may include tangible assets, that is assets that are physical, such as property, plant and equipment and inventory, equity instruments, which represent an entity at the back end, sukuk or other instruments whereby the majority of underlying assets are tangible assets, and intangible assets, for example, right of use assets. So these are considered to be non-monetary assets for this purpose, and for the purpose of computation of tangibility ratio, the ratio of these non-monetary assets will be applied to the definition of according to the definition of tangibility ratio, whatever has been determined by as per Sharia principles and rules. Then when we refer to Sharia principles and rules, it is the one that is defined by AOFI Sharia standards and the Central Sharia Board and the respective Sharia Board according to the hierarchy that we have given. So whatever applies to the institution, according to that, this tangibility ratio will be defined. So we have not defined the tangibility ratio as has been defined in the Sharia standard, because Sharia standard directly deals with the ratio to be applied in the transactions, while here this is the accounting standard only asking for the appropriate treatment and appropriate disclosures and presentation without addressing the issue of ratio itself, without defining a ratio itself. I can see there is a comment in the Q&A tab from Brother Suhail Zubairi. First, welcome, Brother Suhail Zubairi. This is a great pleasure to have senior people like you here. Perhaps the little more clarity on applicability may be appropriate, and what that covers the Islamic financial institutions, such as in addition to Islamic banks, and to also include the Islamic capital market and asset management institutions. In case of capital market, the Sukuk SPV is relevant where there is a flexibility of substitution of assets. Similarly, in the asset management, a REIT and asset may need to be transferred or substituted. Thank you very much, Brother Suhail. We take your comment, but the definition of Islamic financial institution is very clear in our multiple AOFI standards, so we do not repeat it every time. It is covered in AOFI governance standards and AOFI accounting standards. It includes all type of institutions that function on financial transactions as per AOFI, as per Sharia principles and rules, and it includes for sure the capital markets. It includes the virtual entities, which means that it includes the virtual Sukuk entity as well. It includes the windows of Islamic conventional institutions who function as Islamic institution as well. So considering all these things, I would like to submit that it might be a good idea to create a cross-reference to the definition contained in the framework. Sister Farida, can you just make a note of it, that for the purpose of making where we have mentioned the Islamic financial institution in the application side, maybe we can create a cross-reference in the footnote to the framework where we have provided the definition of Islamic financial institution, the framework or the FAS one places. I think we have the definition. So in the footnote, we create a reference for that definition rather than clarifying it again. But Brother Suhail, we fully understand that whatever you have said is understood and included in the definition, which is already there in the framework and other standards. So a duplication every time might not be needed. But thank you very much for your kind comment. No disagreement for whatever you have written to be part of an institution and its covered. There is an anonymous attendee. I would request you to kindly rename yourself. There is an option of renaming in Zoom, so we'll like to request you to kindly rename yourself so that we know the name. The objective of this standard states that the standard is based on internal transfer within a financial institution. So does the reference of sale in para 4F refer to intercompany transactions? May you also provide a practical example of an instance where the transfer of assets within a financial institution happened by way of sale? Actually, every transfer that takes place is by way of sale, except for if it happens by way of hiba. So Hiba or any other form of tabarruk. So the point is that number one, it does not apply to the transactions between an institution and a different company. It does not apply to that. So that part first of your first part of your question, we are clear on that part. So this standard does not apply to the outside transactions. This applies to the transactions which are either on balance sheet or off balance sheet managed assets of the same institution. That is one. Now, how the transfer takes place? So, for example, let me give the easiest example. For example, there is one Islamic financial institution which creates which decides that now we want to start taking urea accounts, offering urea accounts. This is a new institution. So initially they have only one pool, investment pool, that we would say virtual investment pool, that is the equity. But now they decided, okay, on the Mudarba basis, we are going to get some funding. So now for that funding, they need to create an investment pool, and that investment pool will include some part of the commingled equity of the institution and some part of the Rabbul Mal money coming as a Mudarba deposit. The assets that are presently owned by the institution alone are transferred at the starting point to create that pool. This is the first transfer. Second type of transfer is just, I'm putting examples. There is a investment pool which is going there. The rate of return, average rate of return on that pool is 4%. There is a liquidity need for the institution, and they decide that either on Mudarba or Wakala basis, they need to create a separate pool in which there are some high net worth individuals or financial institutions who will get a sort of a higher return, like 5%. So they need to transfer some high return yielding assets to that pool, and that is the second transfer. Now this transfer, according to Sharia, constitutes a sale. So the principles that apply now let me be clear. The problem is that the mindset of the common Islamic finance professional does not understand that this is a sale. They say, oh, we are just tagging the assets. This is very common term used by the bank officials. We tag the asset here and there. No, sorry. If you are just tagging it, then probably you don't even understand Islamic finance at all. Because when an investment pool is created, when you get somebody's money, it's not about tagging the assets. It's not about indexing with something. It is about actually using that money for the purpose of creating an investment pool in which there is a pool of assets available. So the problem is here that in a nutshell, tagging the asset seems to be a superficial sort of exercise. Oh, I'll just do this tagging here and there. At times they do it, to be honest. At times, that's why I said in the beginning, it's very close to my heart, because these are the fundamental flaws in Islamic banking practices, not the theory. This is the problem of differences between the theory and the practice. In the theory, it is a sale transaction. In the theory, the Rabbul Mal owns the underlying assets. But in the practice, what happens? In the practice, they are just using the term tagging. Oh, we just tag these assets here and there. Sorry to say, this is not what the original transaction is. According to the original transaction, you need to use their money for that purpose. So when I just change the tag for my, in my slang language, that actually constitutes a sale between the first set of stakeholders to whom it was tagged for earlier to the new set of stakeholders to whom it is tagged now. So this tagging, which we commonly use, and which we at times do on a post facto basis, which is fundamentally wrong, that is actually something that makes our transactions away from a real Mudarba transaction. If these are real Mudarba transactions, if these are real Wakala transactions, Musharaka transactions, then they need to create an absolute ownership of the investment pool on the underlying assets. If the absolute ownership according to Sharia principles and rules is not there, then this transaction and giving a return to them tantamount to riba. This is something which is a huge challenge with regard to this thing. And in a nutshell, I would like to submit that this is this is a very challenging situation for the Islamic finance industry because this pool management and profit and loss distribution it represents like nearly 70% of the balance sheet of the investment bank of the Islamic banks, 50 to 70%, and it has so many weaknesses. We are trying to cover most of these elements from the accounting side as well as governance side. We are right now at the same time working on a governance standard, very comprehensive governance standard, which will be addressing some of those issues in more detail, identifying certain additional elements which can be put in from the governance and regulatory perspectives. There is comment from Andrei Juravilov. Thank you and welcome. Looks like physical persons are missing in the definition of monetary assets. Honestly, I'm unable to understand your comment. My apologies. So can you kindly explain how in the physical person may be relevant to that? We have then, Brother Mushtaq Ahmed, one-time transfer of asset negatively impact the general pool or in some cases, some specific pool contributors. As the decision makers are the management of the bank, no one can stop them, but can only fit the condition on disclosure of actual financial impact in terms of profitability of transfer of assets on both the pool depositor for general public. Brother Mushtaq, thank you very much for making a great comment. We fully agree with your comment. That's what we are trying to do. But there are two elements to that. One is the numerical aspect, the quantitative aspect that we are trying to cover in this standard. And there is another aspect which is related to the governance and regulatory aspect, the fairness aspect, the fair treatment and transparency between the parties aspect. So the disclosure and transparency part can be covered mostly here, but some of the disclosure and transparency part and the fair treatment part is to be covered on the governance standard. AOFI Sharia standard is silent on these details. So we are developing the governance standard to address those details in more detail. Then those are actually more of the governance aspects. But yes, there are Sharia aspects, like, for example, the buyback risk, the tangibility risk. The fair treatment is not only a governance issue, it's a Sharia issue as well. So we are addressing that as well. Thank you very much, Brother Mushtaq, for your kind comment. I fully agree with that. And that is what we are trying to do here. But let me mention one thing. In this standard, being an accounting standard, we cannot impose that it must take place on fair value. But we are saying that generally it should take place at fair value. But if it is a different than fair value, you need to disclose the fair value impact. That is what we are asking, because this is the transparency issue, that if one of set of the stakeholders, it has an advantage and the other one is at a disadvantage, then you need to do the fair valuation. We have comments from Brother Badru Jafar. Thanks, Mr. Umar. You raise a very important issue. The pool of assets and a Mudarba investment belong to the depositors. What procedure should be followed where the IB wants to sell these assets for whatever reason? Thank you very much, brother. The IB, Islamic Bank, being the Mudarib, is actually having a right and permission from the investment account holders to do it in their interest, not only in the bank's interest, in their mutual interest. So the point is that, yes, we are trying to, as I tried to explain in response to Brother Mushtaq's comment, that we are trying to put controls on the accounting side, and we are trying to put controls on the governance side. Inshallah, shortly we will be coming up with the exposure draft. The exposure draft is partially ready. For first review of that is done already by our governance and ethics board, but I think it will take one more meeting of the governance and ethics board to finalize that exposure draft, and that will come to the market, inshallah, and hopefully we'll be looking forward to have your and Brother Mushtaq and all you guys comments on those very important aspects of the standard. One section of that standard will be addressing these issues, particularly with regard to the transfer of assets. Thank you very much.
Mr. Justin hasn't raised his hand.
Okay, brother. Okay, I think we should allow him to speak. Brother Jasim Al-Ajmi, please, you are allowed to speak, sir. Brother Jasim Al-Ajmi, you raised your hand, so we have allowed you to speak, sir. Okay. I think we can allow him later, or he can put comments in writing. So let me go back to the comment from Andrei Jorovilov. The definition of monetary assets names institutions and entities as parties to whom IFI may be liable. It does not include an individual customer, which is a deficiency. Let me just go back to this. Now, the point is that no, I think I need to explain it a bit. When we are saying this thing, it is not about an institution. Okay, you are talking about exchange of monetary asset with another institution or entity. Okay, good point. Another person, institution or entity. Thank you very much, Sister Farida.
Yes, sir.
Can you please make a note of it?
Yes, I will.
Another person, institution, or entity. Thank you very much. A very good comment, actually. So in the monetary assets definition in 2 and 3, we should say with another person, comma, institution, or entity in 2 and 3 both. Thank you very much for your kind comment. Initially, I couldn't understand that, so thank you very much for that. It's well noted, and inshallah, we'll incorporate that. Highly appreciated. Okay. So now Sharia principles and rules, we have a specified definition in other standards. So here we have put it in the footnotes. We said already it is defined. Tangibility ratio in the specific context of this standard is the ratio defined by an institution in line with Sharia principles and rules and acceptable for the purpose of transfer of an asset or a bundle of assets. So it has to be about a transfer of assets or a bundle of assets from investment pool to another when it involves debt. So if debt is involved, then this is the issue. This is something that if debt is not involved, then we are not concerned about it. Just Sister Farida? Sister Farida,
Yes,
just make
yes.
a note of it. It applies on debt and cash also. I think just make a note of it, we'll discuss. Because I think,
Okay, I'll add it.
yeah, it was added like, involves debt, but I think a debt and cash also, I think it may apply. But we'll just see and discuss it with the Sharia committee. Okay. Okay. Transfer of assets in the specific context of this standard is the transfer of assets from, or simply we can say when it involves monetary assets. It involves, instead of saying it involves debt, we say it involves monetary assets, or we say when it involves debt and cash. And other see, oh, not only debt. The point is, I remember it was added by one of the board members towards the end. It was suggested that because he was not clear why it applies. But the point is that if it is other than that, another monetary asset other than that, or it is only cash, does this still apply? So this is something that we need to address. So just make a note of it. Transfer of assets in the specific context of the standard is the transfer of assets from one investment pool to another, whether on balance sheet or off balance sheet, by way of either sale, exchange, investment, clearing, or other, for example, hiba in line with contractual arrangement, complying with Sharia principles and rules. Okay, so now we move to the next section, adoption and consistent application of accounting policies. As I explained, let me mention in the nutshell what we are asking. We are saying you must develop appropriate accounting policies in line with Sharia principles and rules. Now, Sharia principles and rules are AOFI Sharia standards, country Sharia regulations, central Sharia board regulations, rulings, and the AOFI accounting standards, Sharia implications, and the views of the Sharia board of the institution. So these are the hierarchy items through which you determine what are the Sharia principles and rules. So as an accounting standard, we cannot say you transfer only at fair value. But we are saying that you apply according to the Sharia principles and rules that apply to you. So you follow an accounting policy in this respect. The accounting policy that you follow in this respect has to be, how I would put it, that that accounting policy has to be compliant with Sharia and has to be, obviously, we believe, has to be fair and transparent. So this is something that we cannot say in the accounting in the accounting standard that you transfer it at this value or don't do it at this value, because this is a business decision. Accounting standards do not define the business decisions, but the Sharia standards and the governance standards may actually direct the business decisions. So from that perspective, I'm just clarifying that we have asked not to do a specific accounting treatment. Rather, we have said that you develop accounting policies and consistently apply them in line with Sharia principles and rules, as well as the contractual arrangements with the respective stakeholders. When we develop these accounting policies, those are to be disclosed. We have identified the areas on which accounting policies apply. So there are multiple areas. So transfer of owners from owner's equity to a category or investment pool within quasi equity and vice versa. Transfer from owner's equity to a category or investment pool within off-balance sheet assets under management and vice versa. Transfer within categories of owner's equity. Transfer from a category or investment pool within quasi-equity to a category or investment pool of off-balance sheet assets under management and vice versa. Transfer from a category or investment pool within quasi-equity to another category or investment pool within quasi-equity. Transfer from a category or investment pool within off-balance sheet assets under management to another category of investment pool within off-balance sheet assets under management. So there are three main types: equity, quasi-equity, off-balance sheet managed assets. There can be multiple categories within them. And this list of 6 items actually cover all the possible scenarios. So we have asked the institution to develop accounting policies for all these scenarios. However, the next section says that there is a presumption that item B, D, and F, wherever the off-balance sheet assets are involved, since off-balance sheet assets, when you make something on balance sheet to off-balance sheet, it has to meet the derecognition criteria. So maybe the derecognition accounting policies that are already developed by the institution may address these issues. So I was just explaining that part. Paragraph 6 I skipped earlier. Paragraph 6 says that in addition to whatever are the general requirements of phase 1, you need to apply these accounting disclosure requirements in line with the requirements of this standard. In addition to phase 1 and in addition to phase 12, for example, of takaful. So these sort of policies of transfer shall also apply on takaful when they transfer something from the owner's equity to the PTF, or if there are more than one PTF, then they need to have accounting policy for transfer between the two PTF. And if they have investment fund PIF in case of life takaful or family takaful, then that you need to also apply the same approach of having a proper accounting policy, and that has to be there. Now the next point, which is very important. The accounting policy disclosure should include the following: the basis and reasons that govern the transfer of assets between various investment pools. So not only the basis, but also the reasons. Tangibility ratio and other restrictions applicable to transfer of assets between investment pools. Just give me a second. My apologies for that. So tangibility ratio and or other restrictions applicable to transfer of assets between various investment pools in line with the Sharia principles and rules. Any restrictions in line with the Sharia principles and rules on short-term transfer of assets with expected return to original investment pool to avoid a buyback. Now, this is a very important issue. This is a very common issue by the banks, that they create a pool for 7 days, or they create a pool for 1 month, or they create a pool for 3 months, up to 6 months, up to 1 year. The point is that if the life or of maturity of the asset that is being transferred is more than the life of the maturity of the investment pool, then there is all probability that the asset will come back to the original pool, whether it was owner's equity or it was the general pool. Now, what happens that it creates a buyback situation, because I'm transferring from general pool to a new pool A. New pool A actually is to be matured or liquidated after 1 month. So after 1 month, the asset comes back to general pool. This creates a buyback situation. According to Sharia, there are restrictions on buyback situations, and a buyback situation that results in Bay'ina or Babil Wafa. These are the situations. In case of Babil Wafa, it may be allowed, but the return on that may not be allowed. And in case of Bay'ina, it may not be allowed at all by Sharia. So these are the challenges where we need to understand that these transfers on a temporary basis create a huge risk. That a transfer, we are focusing on the tangibility ratio. If I just transfer a Muraba receivable or a Tawarruk receivable, or if there is a bank which has 90% of Tawarruk transactions and they just transfer between pools the Tawarruk receivables. The point is, even not Tawarruk is more controversial from Sharia perspective, but even if it is a Murabha, normal, simple Murabha where physical assets were involved. But the receivables, when they are transferred, they cannot be transferred at that rate. Similarly, even if I avoid that issue of tangibility ratio by applying a tangibility ratio by creating a bundle of assets, is still I transfer one bundle today and I take back that bundle after 1 month. What does it mean? Don't you think it's a buyback? Now, the problem is that we are saying to the whole world, oh, we are avoiding riba. We are taking you from riba-based transactions to interest-free transactions. But at the back end, what we are doing is actually having so much resemblance to those conventional transactions and which actually are prohibited. So the point is that these are the challenges. Again, as I mentioned again and again, it's an accounting standard. We cannot put Sharia conditions in the standard itself. We cannot put governance and fairness conditions in the standard itself. But what we can say is that you need to be transparent. And if there is any restriction on short-term transfer of asset or any control, it needs to be avoided. Again, multiple challenges related to these areas will be addressed addressed in the governance standard, not in this accounting standard. Now, I think I have two comments here. One from Brother Mustaq Ahmed, 9C. It is stated that to avoid buyback transaction, can UFI consider it buyback or have any guidance about this kind of contract in respect of transfer of asset from one pool to another? Brother, I think you have a good comment. But if you see, we said the term any restrictions in line with Sharia principles and rules. Whenever we refer to these Sharia principles and rules, it includes the first criteria of Sharia principles and rules as per the Sharia principles and rule definition is AOP Sharia standard. We believe that any type of transaction between a stakeholder like this can tantamount to a buyback. And that is why we actually have put this one. Some of these things have been discussed with the scholars who are part of the working group on this one and the part of the working group on the governance side. But yes, every standard of AOP as a practice always is reviewed by the Sharia committee of the Sharia board. So any accounting governance standard, ethics standard, auditing standard that is issued by AOP is always endorsed by the Sharia team. That is normally a Sharia committee of the Sharia board itself. But if there is a significant issue, that is passed on and taken to the Sharia board as well. So we believe that this is as per our current understanding of AOP Sharia standards. It may tantamount to a buyback, and that buyback in some situations may be considered a bay'ina as well. And that is why we did not conclude that this is always bay'ina or buyback. We just concluded, we just required that you need to write down any restrictions which are decided according to the Sharia principles and rules. The last item of hierarchy in the Sharia principles and rules is the Sharia board of the respective institution. So the Sharia board of the respective institution has to take its own view with regard to these issues and has to put a judgment call on that. So from our side, accounting board doesn't take a conclusion that these all returning of assets after a short period, these all may be subject to a risk of being considered as buyback or baina. We are not saying that by default they are baina. That judgment call is to be according to official Sharia standards and all the hierarchy. Thank you very much, sir, for this very good comment. We have Brother Sohail Zubairi with a repo transaction to be considered internal or external, where an IB secures liquidity from central bank by electronically transferring the securities to CB and got them back upon settlement of maturity. Technically, the de facto owners of the securities, mainly sukuk, are depositors whose funds have been utilized to buy them. Clarity shall be highly appreciated. Brother Sohail Zubairi, actually, this is a very good comment, but this is not a subject for now. Actually, what I understand that the Sharia compliant repo, first thing, it is not a absolute sale. It happens with a promise. Secondly, the conditions on the first end of transaction are also a bit open, that this can be purchased by again, every bank and every central bank have different structure. In a nutshell, avoidance of repo to be considered impermissible, in a nutshell, is through having promises rather than having sale transactions. Other Sharia challenges are there in all repo transactions, even if they are Sharia compliant. That is subject of AOFI's standard on Waqf, Khiyar and Tahawwul, not a subject of this standard, Brother Sohail. Even if it is out of depositors' funds, for the depositor funds, it will not appear as a buyback. Rather, it may appear as an instrument appearing on the asset side. Now, considering, like that you want to sell those securities to the central bank, and then you have a promise to purchase them back, and those securities were earlier owned by the investment pool. In that situation, I believe there is a unique additional leg of the transaction. That is because you are borrowing for the institution and not for the investment pool. So first you need to do a transfer from investment pool to owner's equity of those sukuk. And that has to happen and reported according to the accounting policy in line with this standard, and reported and according to this standard. Then when you do this transaction with the central bank, that is to be addressed by the Waqf, Khiyar and Tahawwul standard, because now you are doing it as transaction as owners of the bank with the central bank. We believe that normally this transaction does not happen inside of the investment pool because it creates a liability on the institution, the potential liability and eventually a liability. So from that perspective, I believe that as I can see it, for me, the first leg of the transaction will be unique, where you will first transfer the assets from the investment pool to the equity pool. Once these are transferred from the investment pool to the equity pool, you apply on this transfer the requirements of this standard with regard to the accounting policy and with regard to disclosures. And then the second side of the transaction, where you actually sell those assets to the central bank and then promise to purchase them back and all that, that will create a liability on the institution, not a liability on the investment pool. So for that leg, this standard will not apply. Brother Sohail, your comment was very good. I think it has some more additional challenges from Sharia perspective, but I'm just clarifying to the extent of the application of this standard. I do not want to go to the further details which are related to the repo transactions. And we believe that obviously in UAE particularly, the central bank is also following UAE, that because the central bank is also trying to follow Sharia standards. So, okay. correct basis. And your second comment is with regard to the basis in. Okay. This is, I think, Brother Sohail Zubairi, I think, thank you very much. The problem is that basis, your comment is BASES should be replaced with BASIS. The point is that the plural in the UK English is accepted as BES also. Sister Farida, just please make a note of it, that when you apply the basis into form of plural, Brother Marsh, particularly if you can also make a note of it, that when we apply plural, in the British English, I believe that BASES is also accepted or rather preferred as a plural for singular basis. So it becomes a plural for base and it becomes a plural for basis. But just we'll make sure. Thank you very much, Brother Sohail Zubairi, for your kind comment. Actually, in 9A and 9F, we have used BASES as a plural. Now we are applying, similar to IFRS, we are applying the UK English and all of AOFE standards. And in the UK English, I believe that it is accepted as both. So, but our issue will be to ensure consistency. Thank you very much for this additional very kind comment, sir. Brother Sohail Zubairi's one part of the comment is that at times the equity pool is not large enough to meet with the liquidity needs. Sarji, that is the problem with our Islamic banks. Sorry, this point actually takes me to something, making a bad comment about the banks. The point is, according to most of the Mudaraba contracts, unless you take a specific permission from the Rabbul Mal as per Sharia to incur liability on his behalf, you cannot incur a liability. And our contracts do not allow a liability to be incurred on their behalf. Brother Sohail, I believe you got my point. That according to Sharia, Mudarib is not entitled to incur liability on behalf of the Rabbul Mal. And that's why, according to Sharia, the Mudarba is always by default a limited liability thing. Now the point is that you are putting additional liability on behalf of the investment account holders. This is challenging from Sharia perspective, and to be honest, it is not fair. But there is an approach. The approach is that if that amount is not enough, then you can bring that amount. What you can do that you take out these assets, and then when you get this money from the central bank, you can inject that money as additional capital contribution inside the pool. So there can be some solutions on that, but I believe that putting a liability like this within the investment pool is not justified. It should not happen, and it should never happen unless the contract specifically allows the bank as Rabbul Mal to incur liability on behalf of the investment account holders. And I think that central bank should actually prohibit this practice, because this will enable to the Mudarib or the bank to pass on the liabilities to the investment account holders, and hence their liability will become eventually unlimited. So the easier portion for me is that for this purpose, it is better to do it it is better to do it outside. There are additional challenges to that, sir, as well. For example, the transaction that you are creating on this one is happening on sukuk which are held to maturity sukuk. This is an additional challenge. That if these are held to maturity sukuk, how you can sell them and repurchase them? And held to maturity sukuk, if these are transferred from one pool to another pool, at what value they should be transferred? Because the fair value gains and losses for them are not recognized. These are additional challenges which we need to consider while addressing these issues. Sister Farida, just make a note of this point, that we can consider putting some additional comments on this part in the main standard, not in this one, in the quasi equity standard, that if there is a permission to the investment account from the investment account holder to the bank for incurring liability within the pool, or if there is any liability that is coming inside the pool, how that needs to be disclosed and presented. So I think this is an important point, not for this standard, but I think for the other standard. Again, all of these are part of the same project. So thanks to Brother Suhail Zubairi for raising this very important point, and we need to address that. I think there is another element coming out of the answer that I have provided to him that is related to this part of the classification of investment sukuk, etc. I think we do not want to put it in the body tax, but where we have talked about this accounting policy thing, we need to talk about the changes in classification of assets as a result of, because we talked about valuation here, but also about classification also. In 9F, we might need to add about any changes in the, because we talked about the respective business model. This respective business model actually addresses the issue of, like, for example, the held to maturity investments, etc. So even if the change in business model and accordingly change in classification should also be part of this accounting policy thing and the disclosure part. And I think we need to address that in F, 9F, and also in 10B, I believe. Okay, so now coming to the next section. It's a very short standard, but I think we have taken enough time, so I need to be to be a bit quick now to make sure that we conclude on time. I think we started a bit late as well, so we don't have any comment now. So let's move ahead. So we were talking about these accounting policies as the basis and reasons that govern the transfer of assets between various investment pools, tangibility ratio and other restriction applicable to transfer of assets between various investment pools in line with Sharia principles and rules. Any restriction in line with Sharia principles and rules on short-term transfer that we discussed. D, any restrictions and any specific valuation approaches applied on transfer of any monetary assets in line with Sharia principles and rules. We address that issue, so we are just asking about adequate accounting policy here. Treatment of changes in classification of investment in sukuk. This is covered in E already. Shares and other similar instruments in case of their transfer from one investment pool to another as a result of such transfer or as a result of change in business model. So I think what the point that I was addressing is covered already here, sir. The basis applied by the institution in valuing the assets to be transferred and the rationale in line with the relevant phases and applicable Sharia principles and rules and respective business model in case such valuation is different from fair value. And Sister Farida, the point E is there, but we need to explain it in the basis of conclusion about this example that I gave about the held to maturity investment being sold from one to another, and then you may need to change it to that fair value through income statement or something. The commitments and restrictions applied by the mutual contractual relationship between investors of various investment pools. Then on continuing on this side, the institution shall disclose. These are the disclosures, and these are the quantitative disclosures. These are probably the new disclosures that were not there in the earlier version. So in respect of the following, we need to put qualitative disclosures. Cumulative amounts of transfer between or where material between significant categories of owners equity, quasi-equity, and off-balance sheet asset management at net transfer value and respective gains and losses recognized in the respective categories were applicable, as well as difference between the net transfer value and the fair value of such assets if the net transfer value is different from the fair value. This is for the purpose of having adequate transparency with regard to these things. Again, one more thing. We want to discourage these changes. This should not happen on a day-to-day basis. No, I just do this tagging, this tagging. It should not be a video game sort of thing that, oh, I just tagged it like this and I just tagged it like this. The valuation differences resulting from transfer of assets in foreign currencies and the financial effect of those transfers. The nature in terms of significant assets transferred and where these assets are divisible, separable, and any related Sharia principles and rules applied, as well as the disclosure of significant assets proportionately divided between or where material between significant categories of owners' equity, quasi-equity, or other off-balance sheet asset under management. The point is that at times you can have one large asset. So, for example, there is one huge infrastructure project in which you have invested. So the point is that you have, like, for example, Ijara for a huge infrastructure project. Now, if you need to transfer and your, it is not enough money is not available, then in that situation, you actually need to transfer maybe proportionately that asset. So some of the assets may be transferred proportionately as per Sharia between different stakeholders. So that is something that you need to apply. Monetary assets would not generally be subject to this thing, but non-monetary assets may be subject to this thing. Even in monetary assets, some Sharia scholars may allow you to transfer them proportionately, but still they have to be subject to a bundle. So maybe half of the receivable along with another tangible asset or a non-monetary asset to make it a bundle, then that can be transferred. Transfer of asset transaction conducted with related parties indicating the nature of the relationship, type of transaction, total value of these transactions at beginning and end of the financial period, and the Sister Farida, I think we need to make a small correction here. Total value of these transactions for the period and balances at the beginning and end of the financial period. I think there is a typo here. Total value of these transactions for the financial period
Okay.
and balances at the beginning and end of the financial period.
Okay.
Okay. And the financial effect, whether recognized or unrecognized, in line with respective accounting policy and relevant Sharia principles and rules. So here we complete the discussion on the standard. The tentative plan is that this standard, along with other standards of the same project, will become applicable on 1 January 2025. Early adoption will be encouraged. So we would love to have a bit more comments with regard to the disclosure requirement that we have discussed, and any specific comment with regard to this effective date, if we have any specific comment on that part. So we have no comment. Anybody want to speak or put a comment in the Q&A tab? We can wait for a minute or so. If you want to speak something, you can raise your hands. I think there is a question Q&A tab. Brother Suhail Zubairi has one last point. So Brother Suhail, you want to speak on that, sir, or you want to just you're writing on that? We'll wait for you, sir. Don't worry. Okay, Brother Suhail Zubairi want to speak now. So please, if you can allow kindly that he can speak.
Yeah,
There was another brother who earlier wanted to speak. So you are now allowed to talking is permitted to you, Brother Suhail Zubairi. And again, I would like to thank you for your keen interest. Your senior people like you joining the public hearings actually adds significant value to the standard setting process, sir. So please, you are welcome. Brother Suhail Zubairi, you are allowed to talk.
Mr. Suhail, please go ahead. Mr. Suhail. Maybe he cannot hear us.
Promote him to, maybe there is a problem in speaking. So can you promote him to panelist? At times you may need to promote the person to panelist. At times.
Yes, I think we have to.
In the meanwhile, let me take another comment which we received from Brother Mushtaq Ahmed. Dear Umar Sahab, as a general Sharia related question regarding transfer of assets from one pool to another, if addresses is an ruling of sale transaction is stated by religious scholars that exactly apart one person cannot be like doing transactions at both ends. So one cannot undertake execute transaction on behalf of buyer and seller at the same time. Even if we say that he cannot be principal and agent. Like on one side he cannot be principal and other side agent of the other. So this is this we agree, sir. We fully agree with this one. The problem is we believe that as of now Sharia standard has not addressed this issue in detail. So we are covering it in more detail in governance standard. We fully agree with you, sir. The comment highly appreciated, endorsed, noted. But we are addressing this issue in the governance side. So what we are suggesting on the governance side, I'm just saying the initial thought process that we want, number one, the fair treatment. So it has to be a fair treatment. Number two, according to Sharia, what we understand is that with express permission, the agent can do transaction with himself. If the principal expressly permits him, that you can do transaction with yourself as well, so he can do. So the second part is that there should be specific permission to that, but that can happen only with fairness only. The third part is we are putting we are thinking of putting some requirement that if a transaction takes place on behalf of two of the stakeholders, two different officials within the organization should be given the responsibility to ensure that the rights and rights of the respective parties are fulfilled. So we agree with your point. We are trying to address it on the Sharia, on the governance side, inshallah. No disagreement on your comment. We are trying to find some solutions, and we'd love if you can, just keep in mind that shortly there will be upcoming our governance standard on this area as well. So once the exposure is draft is there, we would love to have your written comments. We can see you have keen interest in the subject. So your written comments will be highly appreciated, along with, obviously, we expect you to join the public hearings. Probably that standard will be finalized in the next, as exposure draft, it will be finalized in the next next working governance board meeting. So it will take maybe up to 2 months or 2.5 months to have in the market. Brother Suhail Zubairi, unfortunately, I can see that your mic is not working, so we'll take your comment as you type now. Thank you very much. Brother Suhail's comment is actually the Mudarba is unrestricted. As such, the bank management can do repo without seeking any permission from deposit holders. Also, the customer deposit also include Wakala and commodity Muraba based deposits. As such, in the diluted to some extent. Let's go. Let me mention one by one. 3 different things you have, sir. First thing is, unrestricted Mudarba does not allow you to incur liabilities. It allows you to do transactions. It does not allow you to incur liabilities. We will ask the Sharia scholars on this point, but our understanding is unrestricted Mudarba still does not allow you to incur liabilities unless express permission to incur liabilities is there. That is one. Number 2, the customer deposit includes Wakala and commodity Muraba. Commodity Muraba becomes a liability on the equity. Commodity Muraba does not become liability on the depositors. So commodity Muraba is considered to be paid by equity. So like current accounts, whatever you receive as commodity Muraba, which according to official Sharia standard, it is not allowed to raise money based on commodity Muraba. I clarify it every time. But if a bank is doing that, I'm not here to say it is haram. I'm just saying it is not acceptable as per official Sharia standard. In a nutshell, even if it is obtained under any liability which is obtained in a contract different than the Mudarba contract, that liability actually becomes a liability on the institution. I'm not talking about Wakala. Wakala, I'll come to it separately. Now, this liability, when you put this liability, the funds obtained under this liability, when you put them in the investment pool, within the investment pool, they are considered equity of the shareholders. Because like current accounts, it's an obligation of the shareholders to pay it back. So for the purpose of the investment account, for the purpose of the investment pool, this will be considered. So you have 2 options: either take out some assets from the investment pool and keep them against commodity Muraba and current accounts. This is option 1, which normally banks don't do because they want to even out the returns for the investment account holders. So the second option is you keep this liability with you, and this liability, when it comes, the related funds come into the investment pool, they are considered equity funds, not liability funds. So from that perspective, the equity is on the liability is on the shareholder, and equity of the shareholders in the investment pool is increased. This is an acceptable form again in case of current accounts, in case of any other liability that is on the investment on the shareholders. So from that perspective, I believe that this happens the way according to AOFI Sharia standards, sir, the way that I am mentioning, sir. That is number 2. Number 3, with regard to the Wakala, AOFI has its own financial accounting standard number 31 on Wakala, which addresses the issues of Wakala bil Istismar in deposits. For us, Wakala bil Istismar deposits either can be commingled or not commingled. If they are not commingled, they become off balance sheet and they need to be kept in a separate pool. However, if they are commingled, according to the permission obtained from them for commingling and according to the terms and conditions which are internally agreed, AOFI Sharia standard and AOFI accounting standard both allow it to be commingled. In that situation, it becomes on balance sheet. So the commingled fund becomes on balance sheet and it becomes a category of quasi-equity in that situation. So it becomes a category of depositors, but not the common category of depositors, but a specific category of depositors. And for sure, we can have some discussion on this issue offline, sir, because we know that you have very keen interest and understanding of the subject. So we can have more discussions in line with what AOFI standards say. I know the market practices at times are not exactly the same as per AOFI Sharia standards. So my pleasure, sir. With that, I think we can conclude. If there is no further comment, there is a comment on the chat window, I think. So any further comments, Sister Noof has mentioned a comment that any further comments that you may have, please provide them in writing to accounting@aofi.com. With that, I will hand over back to Brother Majd. Assalamu alaikum.
Alaikum assalam wa rahmatullahi wa barakatuh, and thank you very much, Brother Omar, for the insightful presentation. We'd like, on behalf of everybody today, to extend our sincere thanks to Mr. Omar Mustafa Ansari, AOFI Secretary General, for the insightful presentation and explanation of the exposure draft of this very important standard. We look forward to seeing you next time around, inshallah, in the near future. We will have a couple of standards this month, maybe, hopefully, inshallah, in Arabic. If you still, for those who didn't have the opportunity to participate or take part in today's session, please extend or send us to your comments and views by email to the email provided in the chat box, AOFI, accounting@aofi.com. Thank you very much for being part of this very essential stage and step of the due process for standard development. Allah bless you all. Thank you. Assalamu alaikum wa rahmatullahi wa barakatuh.